or whatever it
All
is.
right,
West
guys,
Beach degree.
welcome to this evening's live stream. It is a very special happy hour live stream where we are all here together. Jason Hartman, Ken McElroy, and yours truly, George Gammon, the amateur in the equation here with these two amazing real estate professionals right here. And we are going to go ahead and answer some of your questions. I think Kenny's already started drinking. He's got himself a Coors Light right there.
Hey, George,
Hartman's
why
got
do we
himself
have a double
drink? Oh, I think Jason, we got a lag here.
We had a double. There was like an echo for a while. I think it's gone.
I think Jason, you got a lag here.
Yeah.
So
I think it's okay.
Got about a 15-second lag, Jason. Kenny, can you hear me in real time as my mouth moves?
Yes, you're good.
Okay. Got about a 15-second lag, Jason.
I'm good.
Can you hear me in real time as my mouth moves?
No, I'm gonna go out and I'm gonna go and come back. I'll be right back.
Okay. All right, Kenny. So we've got 118 people on right now. Usually, I think I'll probably get up to about 1,000 here. So for the people who are in early into tonight's live stream, let's go ahead and answer a couple questions. You guys, you are on live with one of the top real estate experts in the commercial real estate field on the planet Earth. So what questions do you have? Let's see here. Let me go through the stream. Well, Kenny, I guess we could kind of start with this one. They said, when is the everything bubble going to crash? It looks like home loan volume is slowing down. So you and I discussed this briefly on our interview the other day that hasn't gone live yet. So I'd encourage everyone to stay tuned for that. But what do you think? I mean, the residential real estate, obviously at all-time highs. So that would imply that we're a little bubblicious there and definitely expensive. But what do you think about this metric that the home loan volume is slowing significantly? Maybe maybe home prices have gotten to a point where people just can't afford them anymore, even at these super low interest rates, because it always boils down to a monthly payment. So what are your thoughts on that?
Well, you said it, George. It's perfectly said. The truth is we are in an affordability issue, and now we're starting to see rents rise too. So if you had rentals, obviously in the last year and a half, you were struggling like that's what we had. We have almost 10,000 rentals, and we were struggling collecting, and people were hurting, and all those kinds of things. And we were dealing with banks and forbearance, and people not being able to pay, and all that kind of stuff. It looks to me like the eviction moratorium and the, forbearance piece is not going to be renewed after the end of the month or the end of this month, which is June. So
right.
I would guess that, they're going to have to rip the Band-Aid off here, and we're going to start to see all that stuff percolate up to the top. That would be my guess. And so that would mean more inventory, and that would mean typically more inventory means lower prices.
Yeah. So Jason, you've really got your finger on the pulse of residential real estate and rentals, more specifically with these single family homes, starter homes in linear markets. What have you seen over the past year as far as the renters paying rent? Are you seeing a lot of them kind of take advantage of the fact that they can't get kicked out if there's a Fannie and Freddie loan, or are you seeing the majority of them pay because you deal mostly in A and B neighborhoods? Yeah. What's your take on that?
Yeah, George, that's a really good question. I hope the sound is coming through.
It is.
It's a little strange here. I don't know what's going on, but we were very worried about that when these moratoriums were announced. We were super concerned. But it just didn't turn out to be that big of an issue at all. Really just sort of a non-issue, frankly, for us. Couple clients here and there complained that there were troubles with rent collection, and some of our clients did take advantage of forbearance at first, but then they realized they would keep buying more properties, and lenders won't let you buy more if you're in a forbearance program. So they quickly jumped out of that. But just largely a non-issue, surprisingly. I think that's a little bit more of an issue for institutional apartment owners, and I think Ken just addressed it. Unfortunately, I couldn't hear his response because of the sound problems.
Yeah, okay. So here's a question from Sean, and I'd direct this probably towards Jason and Kenny, see if you've got some thoughts on this. He's asking, should I pay extra towards my mortgage or invest the difference? My mortgage is at 2.75%. And Sean, I'm going to assume that's a 30-year fixed rate mortgage. That's not, it doesn't adjust. It sounds like he just listened to a live stream with Dave Ramsey. What do you think, Hartman?
Yeah. I'm never going to say pay more for your mortgage when that money's so cheap that it's basically free. They're paying you to borrow. Keep that mortgage. If you can get a longer mortgage at a reasonable interest rate, take the longer mortgage and never pay it down. I don't know if you guys are familiar with Rick Edelman, but he's been on my show a couple of times, and he has this this great DVD. That's how old it is. It's called 10 Great Reasons to Carry a Big Long Mortgage and Never Pay It Off. He's a well-known financial advisor, and he's right.
Yeah. Kenny, what are you doing personally? Because I know you use not a lot of leverage. I think you were saying about a 50% LTV. But, if you got $1 billion out there indoors, that still means you got about 500 million in loans, which is a little bit more than the average Joe or Jane. So how do you manage that in your own funds?
Yeah. So first of all, we don't necessarily borrow that in the beginning when we're buying something. So we're buying 2 projects in Houston right now, 648 units total. And we're actually doing a 75% loan on that deal. But what happens, George, over time is as the deal gets seasoned, as you start to pay it down, as the tenants pay it down for you, I should say, then all of a sudden your loan to value, because the value goes up and the debt goes down, the debt principal goes down because it's being paid down every month. So that's why we have those low numbers. So right now as a company, we're somewhere in the 55% range loan to value, but we typically buy, in the 75, even 70, but on our new construction, we're probably more like 65. But we never really go really, really high on leverage like a lot of folks. I'd rather put more money down. And to Jason's point, I think that's exactly right. What you want to do is you want to use that cash. It's not good to be in cash, as we all know, because of impending inflation. But what you want to do is you want to mirror that up with more debt at the price that you already have, because, we already know, I mean, it's facts that the inflation's well over 4% right now. And if you take a look at all these other shadow stats and all these other things, it's probably a lot more. So if you're borrowing below inflation, you should stay there and, not use your cash, because your cash can be used to match it up with borrowing again below inflation. So that's what I would suggest.
Yeah, I think that a lot of people, I think most people are looking at this through the lens of being an owner occupant. If they're looking at it from a lens of, they own an apartment complex, or in Jason's case, they own single family homes that they use as rental properties, it might be slightly different. I mean, one strategy there that I think is prudent, that may be wise for people to consider, is the complete opposite of that. From a standpoint of, if you buy a property, you know what you're doing. Let's say you buy a property that's worth, the comps are $100,000, and you go in and buy that property for $50,000, and then you put 10 or 15 into it to fix it up, and now all of a sudden it's worth $100,000. You've built in a tremendous amount of equity. Or in Kenny's case, if you go in there and buy a property that's failing and you repurpose it and get the P&L turned around the right direction, you increase rents. Now all of a sudden you're able to take a cap rate on those increased rents. Therefore, you've forced appreciation, and you can not pay down the loan. You can borrow more money at a 75% LTV and take out all the money that you put down to secure the property, and remodel it or repurpose it in the first place. Is that a strategy you've used in the past, Kenny?
Yeah, and to your point, George, that's all tax-free money. So when you pull money out of real estate in the form of debt, let's say, a lot of people call it a cash out refinance, that's tax-free. You don't pay tax. You don't pay tax on that because it's debt and you actually owe it back. So now on a home that somebody owns, like you pointed out, and there's probably some people that are asking that question for that, what I like to say is, it depends on your situation personally. So if you're retiring, let's say, and you're on a fixed income, probably not a bad idea. But if you've got several, buckets of money and you've got, some side hustles going and you've got revenue coming in from multiple spots or you've got a bunch of reserves, then I don't necessarily, I wouldn't necessarily do that. And so kind of a rule of thumb for us is we like to have 1 year's mortgage payments reserved in escrow on all of our properties. So at all times, and the pandemic pretty much made us realize that was a good decision, because we had, we weren't sure what was going to go on with people that were paying. And so whether or not it's you paying your home mortgage or whether it's tenants paying us and us paying our mortgage, either way, we had, some uncertainty. So as a company, we have 1 year's reserve. And then, then I'm happy because I figure, well, from that point, at least you're covered for 1 year. You should be able to figure it out.
Yeah. And I think that illustrates another great point on why Schumpeter's creative destruction is so important. And in this world of participation trophies, we've created an environment where we don't not only do we not let little kids fail, but we don't let big, huge corporations fail either. And the problem with that, and what Milton Friedman pointed out so many times, and Jim Rogers has pointed this out as well, is the loss component of profit and loss in a free market system is just as important as the actual profit, from a standpoint of businesses that behave imprudently need to go out of business and be taken over by the people who made good decisions. So if we're talking, let's compare two people here. So we've got Kenny that's got a great, secure capital structure. He's got all of these reserves to cover his mortgage. Therefore, if we have a big downturn in the market, regardless of whether it's because of COVID or whatever else, he's in a position, he's got dry powder. He's not hurting because tenants aren't paying rent. He can go in and buy those assets from people that were over leveraged and took on too much risk and made bad decisions, really. And therefore, all the productive assets go to the individuals who are making better decisions, you see. And that's why it's so important that we allow businesses and property owners to actually fail, because the system becomes stronger as a result. But if we prop up everybody, then the Kennys of the world don't have as many opportunities. And therefore, you get these zombie corporations and these zombie private equity funds that own all of these properties, and the system isn't as strong. And in fact, it's even more fragile than it was before. So I don't want to go off on a tangent, but I thought I'd point that out. Okay, let's look at another question here. Guys, if you do me a favor and start the comment with question. Oh, well, here, Wayne Smith wants your opinion, Kenny, on building materials. Do you think that they're going to continue to go up in price, or do you think they're going to drop?
The $1 million question. It's a good one.
Yeah,
I'll tell you what.
For you.
So we're building 4 properties right now. We have 1 under construction. We have 3 more land deals and so the issue we're having right now is, you think about it, we need prices from the subcontractors to be able to go to the bank to get a construction loan. Well, the subcontractors won't commit because if you're a concrete guy or a framer or, whatever OSB, let's say, or whatever you are, you don't want to commit to me because you don't know if the price by the time we build the property 5, 6, 7 months later, let's say, or wherever your trade comes in, you can commit. So we've got this chicken egg thing going on right now. And so it's really crazy. So on one project, we had our framing bid, just lumber alone, was 1 million high, 1 million. So, so we were able to bring that down a little bit. So to answer his question, I do believe that prices are going to come down and they're going to start to normalize. I really do, because if you look at the disruption, a lot of it had to do with this pandemic. Now we don't have to go all down the rabbit holes as to why on the sawmills and the trade between the U.S. and the other countries and all those kinds of things. But the truth is, a lot of the things we're having a tough time getting flooring, we're having a tough time getting paint, we're having a tough time getting appliances. So all that stuff, if that doesn't point out to you guys that we are literally a global economy, I don't know what will. And so as things start to calm down, then for sure we're going to start to see the prices kind of come back, because all that's happening right now is that people are bidding for the scarcity, and it's driving it up at the moment.
Yeah. So the cure for high prices are still high prices.
Yeah, exactly right.
Yet.
Right. That's right.
Okay. So
I'm back.
All right. So here's a question for you guys. And I think this could be very interesting. Carrie on Facebook is asking, what do you guys think of RV parks?
Well, RV parks are mobile home parks. They are different.
Yeah, the specific question is RV parks.
Yeah. And RV parks, that's like running a business. I own a mobile home park and we have a couple of RV spots in it. But, that's like nightly rentals. And so that's a lot more business complicated, a lot more management, like running a hotel versus an investment where you've got long-term rentals. Kenny, have you ever done anything in mobile home parks and RV parks or anything?
Yeah, we've done some, and obviously we have self-storage too, and we have obviously RVs they're not RV parks, but we have RV storage. But and we do wines. We've done wine storage too, which is interesting, which is a whole different topic. Which you
were telling me about that. That's interesting. Yeah.
But I will tell you this thing, I look at a lot of these things, cover mobile homes, RV parks, as kind of covered land plays. And so for me, it all boils down to math. So, if whatever you buy the land for and, whatever the historical revenues have been minus the expenses, that pretty much tells you whether it's a good deal or a bad deal. So sometimes we've bought mobile home parks that might be on the edge of town, because in the path of progress, maybe later we can convert that to, commercial shopping center, maybe a multifamily community or something like that.
Interesting.
So it's like that's why I call it a covered land play.
Yeah, so you're just cash flowing it while you wait for the land to appreciate to a point where you want to hit the bid. Yeah,
because land doesn't cash flow, as you know. So unless there's something on it. So now, not to say that that's the only use for, this RV park might be in a great spot. It might be always full, might be next to let's say a national park, who knows? But, so not all RV parks are created the same. As you know, some will be out in the middle of the country and some will be right across the street from, the Yosemite, let's say. And so you have to kind of look at them individually.
Yeah, that's a good idea. I never thought about that, Ken, how you look for a piece of land that's in the path of progress, and then you cash flow it, because at that point in time, it's probably highly illiquid. You just put some sort of storage, like RV storage, or I actually rent an RV storage space in Tucson, and man, they have a huge lot there that now is all surrounded by residential. When they set it up, I would imagine it was probably out in the middle of nowhere.
Yeah, So that's how they all are. I was looking at a couple on the outside of Phoenix for the exact same thing. You know, the problem with land is it's really truly just an expense. And, you know, because you have your property taxes and, you know, perhaps maybe some utilities or whatever that might be. And so what you're always looking for on any kind of land is, how do I monetize the land? And, you know, we've done it with we've done it with even billboards. So, you know, like a lot of the areas that you'll see stretch between, say, city to city, you might have opportunities to put up billboards, and you might maybe make, you know, a couple grand per side per billboard. You know, so there are ways to do, you know, land deals and not just have them as, you know, kind of an expense.
A negative carry. Yeah.
Yeah.
That's a great point. All right, let's so shouldn't I just wait and hold my resources in precious metals until real estate bubble implodes? Ross, the problem there is you don't know. Real estate, I'm assuming you're talking about residential, has to come down to its historic trend line. That's it just does. The problem with that is you don't know if it's going to come down in nominal terms or just adjusted for the rate of inflation. See, the real estate bubble could implode by real estate prices going up, but they're just not going up as fast as the rate of inflation. So if you have your property or the property that you've got your eye on, that you're waiting for the bubble to implode, it could go up 5% per year over the next 10 years. But if the rate of inflation is 10%, then it's still going to implode in terms of purchasing power, but the price is going to go up, the nominal price. So it's then you have to really answer the macro question as to whether or not you think we're going to have a deflationary deleveraging in the form of asset prices or an inflationary deleveraging. And that becomes a very difficult question to answer. It's a matter of probabilities. But it's very difficult to sit there and say, okay, real estate prices are at all-time highs. Therefore, we're going to see something exactly like we saw in the GFC. So I'm just going to wait for that moment in time. Another thing that makes it even more difficult is, and Kenny and I were discussing this the other day, real estate typically doesn't implode in the sense that it's not like the stock market where you wake up one day and it's 20% lower than it was the day prior. Looking at like Black Monday in 1987 as an example. Look at the GFC. We peaked out in 2006 and real estate prices bottomed out in 2012. 6 years later. 6 years. So even if we had another GFC type of event, that would mean that prices won't implode fully, if you want to look at it that way, until 2027. So, and that's if prices started going down right now. So there's a lot of dynamics there. And then lastly, what I'd say is be careful, because what you're doing is you're trying to buy a dollar denominated asset with holding something that can go up or down in value in terms of dollars. So that I'm not saying I don't like gold. I definitely do. And I think it's a great store of value. And I think everyone should own it, 10% of the portfolio. But I don't know that it's a good strategy to hold gold until the dollar price of real estate goes down for the reasons I just mentioned. I don't know, guys, do you have anything to add to that?
I'm back.
Yeah. I would agree with you, George. I think that, you know, real estate, there's a lag with real estate. So, you know, you want to buy it from the bank after the bank's held on to it for a while. That's the best time, you know, because they're frustrated. Right. It's a negative drag. It's, you know, it's called REO, or real estate owned. When a bank has toxic assets that they've taken back from defaulted loans, that's not a good they don't get a good rating. And so they're very motivated to get that off. The problem is the, depending on what they loaned it on, they're going to take it back on their books for what they loaned it on. And so what you want to do is you want to make sure that you're not buying too early. It's what I like to say, don't try to catch a falling knife,
right.
Let the market, kind of drag it down to what it's supposed to be. And so we did this in 2010, 2011, where banks were doing big write downs on their loans. And so, it affects the bank's share. So if let's say you're a shareholder in the bank during that time, that would have impacted you because it would have impacted the profitability of that bank as they were writing down the loans, but they're not motivated for a long time. The bank's like, first of all, the seller is going to try not to default. And the last, and then if it does go to the bank's not going to just move the asset right away. It's going to try to sell it at the highest price. And then it's just going to have to make its way.
And there's a big lag time in the pre-foreclosure stage too.
Yeah. Right. That's what I was going to say.
So to your point, George, 6 years is, that could be, I don't know if we use 2006 to 2008 as that time frame, it could be easily that long again.
Yeah. Kenny, were you doing real estate in the early 1990s?
Yeah.
You were in the game right around then, weren't you? That's probably when you got involved. Didn't we have a dip in real estate in the early 1990s, or was that just in the East Coast, or was that more widespread?
Well, there were a couple things that happened during that time frame. I think one of them was the .com bust.
No, I'm talking about the early 90s.
That was late 90s, right?
Oh, before, yeah. Okay, yeah. And then so in the late 90s, I'm trying to think of what it was called, but I was on the West Coast during the time, but
I just remember Trump.
I can tell you SoCal had it, yeah. And and Trump's bankruptcy in New York and so forth, yeah.
That was in the early 90s, Jason?
I don't know.
I remember hearing
Trump
that
he had a couple, he had like two really rough spells, and I think one was the early 90s. I think you're right.
Yeah, it's either early 90s or late 80s, something like that. I know there was a real downturn in the market. I didn't know if it was just regional, or I guess it probably was just regional because, that was the whole mantra in the middle 2000s is that real estate nationally had never gone down as far as price in nominal terms. Okay.
I can definitely tell you that in the mid 90s, I was in real estate in Orange County, California, and there was a pretty tough market in the mid 90s for sure. At least in Orange County. Now that was when the Orange County bankruptcy, and you might recall the name Bob Citron, who decided using the taxpayers' treasury money, it was good to speculate in derivatives with their money. You can't make this stuff up. I mean, and Merrill Lynch was right there helping them do it.
So if we want to call that like a bear market, how long did that take to hit the bottom?
Oh gosh, I don't know.
Was that 3-4 years, or was it?
But to I just want to expand on what Kenny was saying, and that's one of the things that happens. Ken talked a lot about the way the banks operate, but we also have to look at, of course, the way all these individual sellers operate. And sellers capitulate one at a time and capitulate slowly, right? So they look at the neighbor's house and they always think, well, my house is better than the neighbor's. Somehow that's everybody's house is always better than their neighbors. I don't know how that's possible, but it's a psychological thing, right? And so they think they got to sell it for more than them. And it just takes, when sellers are pricing their home, in a down market, they're always looking in the rear view mirror. And in the upside market, they're always looking out the shield in front, thinking, oh, it's going up more and more, I'll just wait. And so it's just a funny psychology, but what happens in the down market with that spiral is people get caught chasing the market down, and their houses become stale on the market, and everybody wonders, well, why isn't anyone buying this if it's been on the market so long? And I remember, when I was in traditional real estate, I had some listings that literally took a year to sell. It was absolutely crazy,
Mm-hmm.
Yeah.
I see Burrick's in the comments here. Jason, thanks for hanging out. He's a good buddy of ours, Jason Burrick, with Wall Street from Main Street. And
hey,
by the way,
Jason.
Burrick, I got to get you on the show, buddy. I'm just packed or I'm swamped until Rebel Capitalist Live, but probably sometime early July, get you back on the show. But he's got a question here. He says, can George, Ken, and Jason comment on how many of their friends with no stock market knowledge or experience are posting on social media about buying GameStop and AMC call options? I don't know. Not really a real estate question. I don't know if you guys have been following that. But these meme stocks have exploded.
AMC, George. That's the moneymaker.
that they've exploded to the upside there. So basically, Jason Burrick is trying to kind of get some anecdotal evidence as to how much hysteria there is with the retail market, with people who have absolutely no clue about the stock market, but they just heard that this is a way to get rich. Yeah. So they're piling in and buying these call options. Do you guys have any buddies like that?
That or Bitcoin,
just one.
Yeah.
I just have one. It's called Reddit.
Yeah. Most of their buddies are real estate guys, Burrick. So I don't think they've got into that. But although I've got a couple buddies that I would use as proxies on hysteria, let's just say it that way. And they have not talked about GameStop and AMC, although they have talked a lot about Dogecoin or Dogecoin, or whatever the hell it's called.
Yeah, so whatever it's called, right?
So there you go.
I'd rather own the building that AMC leases from, by the way. So
that's a good point, Ken. I like that one. Yeah. The building is the most stable asset of all.
Yeah. Yep. Yeah. That stock is just a derivative.
Yeah. Hey, by the way, let's expand on that, Ken. That was a really good statement you just made. The stock is a derivative of the real estate, right? Because AMC has to have the piece of real estate in order to operate. And so out of that piece of real estate that is, say, the real thing, if you will, I think that's what Ken's getting at, the derivative is the business. And the derivative of the business is the stock, right?
Right.
Ken, you want to expand on that at all?
Yeah, what I like to tell people is, like, you could own the McDonald's building, right, or you could own which is real estate, or you could own the McDonald's franchise, right, or you can own the McDonald's stock. Which one's safest, right?
Right. Yeah.
It all just gets further and further.
Yeah, it gets further and further from the core, from the source. And if you think about it, folks, you always, when in any relationship, right, business deal, you always want to be as far up the food chain as possible, right? So that's what Ken is saying, right? The best thing is, and you ask Ray Kroc, right? Because we all saw the movie The Founder. Now everybody knows the story nowadays. They didn't used to know it, but it was all about the real estate, right? And then the secondary thing was the business, and the third thing was the stock. Yeah.
All right. Okay, so we've got REI Diaries. Question: I keep telling myself, invest for cash flow, but this is a crazy market/economy. Are you guys profiting from inflation in the short term at all? Any short-term flip? So what he is saying is, have you guys taken advantage of any of these extreme price moves and have been like, you know what, I'm a cash flow investor, but this price or this property has gone up so much in value, I'm just going to go ahead and flip it and pocket the money.
I've sold some cars.
Yeah.
Well, you think about it, like, no, it's truthful. Like, new cars aren't coming in, so some of my used cars have jumped, and so I'm like, man,
isn't that amazing?
Yeah. So I actually have. I've sold so far 3. I got another one I'm selling. I'm going to sell another one, and I'm paying more than I'm getting more than I paid for on these used cars. So yes, not into real estate because I'm a holder, but I'm definitely profiting from inflation.
Right.
Yeah.
And so,
what about you, buddy?
Yeah, I haven't been flipping, but and I'm a buy and hold guy too. I am doing one 1031 exchange. I did 4 properties for 2 more expensive properties, which I usually go the opposite direction, by the way. This was weird. I just went the other way this time with this exchange. But even if you don't flip it, I you make money because this is such a fast appreciating market. And of course, you can refi to get your cash out, or you can just enjoy the wealth effect, right? You don't have to realize it necessarily. You can just look at what's happening, and it's a very pleasant time in that respect. But the rents are lagging, as they always do. The rents always lag the appreciation,
Yeah.
and so rents are way behind.
Jason, you've got a strategy that I've heard you talk about before, where you sell some of the properties in your portfolio that have gone up in price. In other words, the RV ratio has gone down.
Right.
And you parlay that equity into properties with better RV ratios.
Yeah, and I usually do that, George. Now this time I went the other direction. Pretty much every year I'll do an exchange, or mostly every year I think. I'll do an exchange where I'll sell one highly appreciated property and I'll buy 2 in its place and move to an even more linear market. And I call that the 2-for-1. A bunch of our clients do it. We help clients do it all the time. Sometimes they get a 3-for-1. But this time around, it was kind of weird. I sold 4 properties and I only bought 2. I just bought more expensive, higher quality properties this time. I don't know. I just did something different, but I usually do exactly that.
But but the bottom line is that may be a good strategy that you might want to consider. REI Diaries is, if you've got some properties, maybe sell the ones where the RV ratio has, not in terms of your cost basis, but in terms of the comps, have gotten low, and then parlay that into maybe another market that has a better RV ratio. As an example, I know Hartman has gone into, with his clients, I believe Denver at one point in time, didn't you?
A long time ago. Denver's way too expensive now.
Yeah, but my point is, if you had clients that went into Denver, those prices would have really, really gone up. And that would have given you an opportunity to cash out, take that equity, and go into a Little Rock, Arkansas, or an Indianapolis, or something like that, where you're taking that gain and taking it out where there's a lot more downside, because that market has turned into like a hybrid cyclical market, and then put that equity in a market that's got less downside because it's more linear, and you're getting a higher cash flow per your equity.
George, you wouldn't believe this, and I don't know if I've ever told you this, but in 2004, 2005, 2006, I was helping people buy properties in Austin, Texas, and you couldn't touch Austin today. And then Denver, probably the last property we sold in Denver was maybe 2013, possibly right around there. And these markets, they all just get too expensive, and then you need to do like what I call the water theory. Right now, this isn't water; it's Remy Martin. Okay. You notice I brought the whole bottle with me just in case I want a refill. And but if you spill this, right, it's going to seek its lowest point, right? That's what the liquid is always going to do, go to the lowest point. And money kind of does the same thing. And I bet Ken has noticed this, or actually done this himself, right? Where one market will just be too expensive, and you need to wait for the rents in that market to catch up with the prices. And that takes a few years, usually maybe 3 years, for the rents to catch up. And but you go into another market where the prices are lower, you do a 1031 tax deferred exchange, you have no tax consequence, and it really is nice. Typically on that 2-for-1 deal, and these are just little single family homes, not big apartments like Ken is working with. Our people will typically triple their cash flow. They'll go from like $200 a month positive cash flow to maybe $600 a month positive cash flow, and they'll have 2 properties instead of 1 property. And then those will start that appreciation cycle, and they do it again. It's It works. It's there's that old saying, most people overestimate what they can do in a year, but they underestimate what they can do in 5 years. And
right.
that's
Very
so true of real estate.
True of everything. Yeah, I asked this question in a way to Kenny the other day when we were doing an interview, and I'd like to get your take on it. So on this topic of selling something and parlaying that equity into a property in an area that has more upside or has better risk reward, would you sell a property based on the laws changing for landlord tenants? And or would you sell a property because you thought that there could be more social unrest in those areas that you just don't want to deal with, maybe because they're in a blue state instead of a red state?
Yeah, well, it's happening right now. It's definitely happening. We're seeing a flood. Yeah, I'm in Arizona, and I know you guys are in Florida, but you guys are probably seeing a flood of people, 1031s, and they're coming in from California, Washington right now into Arizona like crazy. And that's what's going on in Texas, as you know. Big names like Musk, are relocating to Austin from California. So that's not new news, but the truth is that's not good for, when you have, that's happening all over the place with people's names that you would never know. And we're starting to see that now, George, a lot.
Yeah, but would that prompt you? Would something like, let's say you had a property that hadn't appreciated, let's say you had a property in Chicago. And it hadn't appreciated that much, but you had made a bit of money, and it was a good cash flowing property. But you said to yourself, you know what? I just don't like the direction that the politics are going here. I see it as a potential hotbed for social unrest moving forward. Or maybe you don't see it as a potential hotbed for social unrest, but maybe they change the landlord laws to really, 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 really favor the tenant. And then you're like, okay, I need to get the heck out of here and take this equity and move it somewhere where it's going to be treated better. Have you guys ever had that?
Yeah, I'll give you a real example, and I'll just pick on Oregon for a moment. So I did a big project in Portland, and what we're seeing right now is affordability issues all over. And so different cities and different states are handling it differently, but Oregon decided to do a statewide rent control, which basically means that, they're going to regulate what you can do as a landlord. But on the other side of that, they're also looking at the landlord or the real estate owner as the one that can pay higher property taxes. So, so they're jacking your expenses and they're capping your income. And so anybody is not going to want that kind of control if they're a real estate investor, as an example. So yes, the answer is we moved out of Oregon because of the laws and the things that we saw. And obviously we're buying properties to make ourselves and our investors a profit, just like a lot of people are. And that's the way it works. And so cities do these kinds of things, and it's their right to do them. But the landlord, of course, or the real estate investor, also has a choice. Like they can go wherever they want.
Yeah. What about you, Jason? What type of experience do you have in that? Have you moved your equity somewhere where it's going to be treated better?
Well, George, I love the point that you're alluding to. The old saying, money always goes where it's treated best, right?
That's right.
It's a great thing. And if you look at this is really the same thing that multinational corporations think about, and you hear them say this on the news. They call it political risk, right? There's political risk. If you want to open up a plant or an oil refinery in, say, Venezuela, right, years ago, and then your whole plant, your refinery is nationalized. The government just comes in with, soldiers, and they take it over and they say, hey, look, sorry, it's ours, leave, and that's what happens. And I've definitely done that. I left the Socialist Republic of California 10 years ago, and I moved to Arizona for 6 years. And I just kept moving till my tax rate went to 0 on a state level, and now I'm in Florida. and I remember Ken, the day I moved to Arizona 10 years ago, and I remember crossing that state line and seeing the sign "Welcome to Arizona." Right? You've I'm sure been across that line many times.
Yeah.
And I thought, my state income taxes just dropped by 69%. That was the difference at the time between California and Arizona on state taxes. That's huge, huge. Not to mention the other cost of living, right? Everything else.
Yeah.
So it's expensive. So, yeah.
Well, a couple questions here quickly. Jason, number one, I saw thoughts on Jacksonville, and I think you've done some homework there. What are your thoughts there, really quick?
Jacksonville is the largest city in America geographically, and we've had many, many investors buy in Jacksonville. We like it. It's a great market for rental properties. We're fans of Jacksonville. We don't have much in the way of, most of our focus lately has been leaning toward new construction properties, and so we're not doing as much business in Jacksonville as we used to. But I still think that's a fine market. Nothing wrong with Jacksonville. It hasn't become hybrid, meaning when we look at the three types of markets: linear markets, cyclical markets, hybrid markets. Cyclical being the expensive markets, West Coast, expensive Northeast, Miami, Fort Lauderdale, those are cyclical. Most of the country being linear, the Midwest, the Southeast, etc. But a lot of these markets are becoming hybrid as they sort of get crazy and appreciate a lot. Atlanta is definitely now a hybrid market.
Yeah, right.
So it's in the category of Denver, Phoenix,
Yeah. So we've got a question here from Unicorn Farting Glittering Rainbows.
The creativity is great.
Yeah.
By the way, that's my new name.
Hey, Ken, be careful what you wish for.
We'll go UFGR as an abbreviation, but no, they actually don't have a question. I just wanted to say their name out loud because I thought it was hilarious. But another question that I saw is, what do you guys think of farmland?
Oh, I got an opinion on that. Ken, you want to go first?
Yep. Yeah. I actually, I actually did a podcast with a good friend of mine that does this for a living up in the Washington State area. I was up there, and it's definitely more complicated than you think. But I will tell you what he's done is he's gone and bought farmland that had chickpeas on it to expand his organization, which is basically hummus. He's a hummus provider. And he's done very, very well. So he pays the farmer a fixed price. He gets the crop. And but I know this much about it, but there's a great podcast that I did that I think can explain a lot, because I said to him, what are some things that people should ask if they're doing farmland? And he had a whole bunch of stuff. So just go to my YouTube. His name's Phil Heinrich, and HTC Trading, and it's a very, very, very good podcast. But I would annihilate what he said if I just tried to wing it.
Yeah.
Good stuff.
What do you guys think of, we got a question from Da G himself. So what do you guys think of Honolulu, Hawaii, with its finite amount of land? Do you see it being affected if the market has a correction?
Way too expensive.
Yeah.
Ken?
Yeah. Well, if you look on blackknight.com, which is, monitors the forbearance, it's one of the you should go there and take a look, and you can kind of see Hawaii is on the top of the list for defaults. So there's a lot of defaults right now in Hawaii. Now, obviously Honolulu being the biggest city in Hawaii. I'm a massive fan of Hawaii, but it's interesting because what's going on there is which could happen in the United States is there's 3 generations living in a lot of the households. So you have the grandparents, the parents, and the kids, which is very unique there. And that's because of the affordability issues. And it's been that way for quite some time. So I'm not sure what right now. I think Hawaii is a winner over the long haul, of course. But again, it just depends on where and how much you pay. And, if anybody wants it after you buy it, right?
Yeah, I think that's really a market for investors who are more about appreciation and less about cash flow. And personally, I don't think that's a good way to invest in real estate or anything for that matter. So that's why I don't really like it.
That's not investing, that's speculation. Hey,
Yeah,
George,
I agree.
just a quick comment on the farmland thing. I just wanted to throw my 2 cents in on that. So we've looked at that a bunch of times over the years, and conceptually, farmland is great, right? Because people will always need food, and farming is super important. Of course, it's very important. But I just, we have a client who does financing for farmland, and I talk to him from time to time, and the yield it's so low on farmland. Now
right.
we've obviously got Bill Gates, the evil Dr. Evil Bill Gates, right? Buying up farmland like crazy. I don't know what's up his sleeve. Anything you can monopolize that's needed is probably going to be a great deal, right? But for the rest of the people, I just think the yield on farmland is just so low. It just doesn't really work.
Yeah. Hey, Kenny, here's a question: are you taking LPs? This person says, if so, how to get in touch?
Yeah, thanks, George. So just go to kenmcElroy.com and you can follow the investment portal. We have we just put a deal out, and it's high net worth accredited. That's as you guys know, we just funded one. It's what's interesting. You'll love this. One of our investors on that deal, Jason. It was a woman. She's like, I'm accredited. I can't wait. I'm going to invest. Then right before she had to fund, she called and said, well, I was in crypto and I'm not accredited anymore. She went from, so that's, kind of going back to that earlier comment with you, George, like things do go up and go down, and be very, very careful, and you're not going to be able to time it. So I felt bad for her, but it does happen. But we do take accrediteds at kenmcElroy.com.
Yeah.
Okay.
And folks, to that point that Ken made, speculate 5%, maybe 10 of your net worth, depending on how much your net worth is. You can do your Bitcoin, you can do even gold. Might be a little speculative, I think. I don't know. George might disagree with me on that, but the core of your assets should be things that produce income. My definition of an investment is, if it doesn't produce income, it's not an investment. It's just a speculation.
Gotta pay it on it. That's how I do it.
Yeah. I love the way you say it, George. It's great.
Okay. Let's see here. We had...
How many people are watching, George?
1,070.
Oh, wow. That's fantastic. Well, hello, 1,100 people.
Yeah.
And then we've got more on Facebook too. So that's
thanks guys. Thanks for taking your time today. I appreciate it.
Yeah.
Yes. Man, I had a question right here.
Thanks for joining us.
Thing skipped. I hate it when it skips like that. Storage units. All right. Well, let's go with this one, Kenny. I know you've got a lot of experience in storage units. So, what are your hot tips, or what are the things to maybe look out for when someone's considering a storage unit facility?
Yeah. So here's the thing. We own some. So I do have a experience with this. In fact, I was just talking with my partner an hour ago, right before here, on one that we have in Corpus Christi. It's 650 units. The thing about storage is it's very testy. So in other words, if there's a lot of storage facilities in the area to a smaller area, you're not gonna be able to move the needle on vacancy. And because, what happens is, like an 8x10 or a 10x10, or, the actual unit itself is kind of fixed. You know, and if the place across the street lowers it by $5 or $10, then you kind of have to do the same thing
Yeah,
because you're
right.
competing. Yeah, so they're really testy, and you know, the other thing is you're not going to find a lot of value add in a storage facility. So when you buy it, it's not like you can, you know, upgrade the flooring and the paint and, you know, all the stuff that we do in our apartments. You know, people are looking, you know, for a storage unit. They want safe, clean, you know, all those things, but they also want it to be very, very they're price sensitive. So they're great mailbox money. So don't get me wrong. If you buy them right and they're full and they're in an area where there's not a lot of competition, you're going to love that thing. But you know, again, it's just math on the income and the expenses, and all the expenses are different based on property taxes and insurance rates. Like my Corpus Christi property, you know, we went through a hurricane already, you know, and so our insurance rates are higher. Oddly enough, that property wasn't impacted, and so we immediately had 200 FEMA clients, you know, from all the people that were.
Wow.
So
that was great news then, right, Ken?
Yeah, but then they moved, you know, a year to a year and a half later. So, you know, it was temporary. It was great for us. Don't get me wrong. And so, but they are testy. And so you just got to make sure there's not a lot of competition.
Yeah. So Jason, sorry about putting that over your face there, but I just wanted to do that so I wouldn't lose the question.
Sure.
This was the one I was looking for. What do you guys think of Airbnb?
Well, I think it can be great. I think it might be getting oversupplied, and it's definitely much more active management. No question about it. But you know, and there's a lot of different things you can do in the Airbnb world, right? And also, you know, remember you said Airbnb, not short-term rental, which is interesting. You know, that's like Kleenex, Coke, etc. now. But you know, you're dependent on one platform mostly, because VRBO is nothing compared to Airbnb, right? And you know, Airbnb deplatforms people just like Amazon does, and Facebook and Google and everybody else. So there's definite political risk, as we were talking about earlier there. So you know, make sure you have a plan B. That's what I'd say. But yeah, it can be great. I have a lot of friends that do very well with Airbnb type properties, and you know, I'm sure Ken does as well.
Yeah, I would just add a couple things. The number one is, you don't want, if you're buying something, you want to make sure that that's not your only, that you know, that it cash flows if you have to rent it long term. So if you're buying something based on the Airbnb revenue, be very, very careful. Right. The other thing is municipalities and HOAs are cracking down on these, and they don't like them. So you know, and so make sure that you know, because you could buy something and base it on that kind of revenue, and then like this, I know that the city of Santa Monica just said that the investor has to be living on the property. They have to have a business license. And, you know, they're starting to put all these regulations in on the actual host or the Airbnb owner. Right. So there's all kinds of things happening around Airbnb. And also, it's also heading into a bad time, because hotels are starting to open back up. So Airbnb had a really nice run during the pandemic because people were looking for places to go. And so there's a prediction that the stock price is actually going to take a dip. In fact, Carl Icahn is doing a big short. Yeah, I read a whole thing on it, on some malls, and I think he said also Airbnb, because he thinks that it's going to take a hit as these resorts and hotels open back up.
And so what's happening there is the price pressure of the hotels and resorts will, they'll be offering very good incentives to attract guests, and everybody's going to weigh the option: should I rent this Airbnb or should I just get a hotel, right? And and they're going to weigh that option. One more thing I've noticed on the Airbnb: we only do the short-term rentals in one market, St. Augustine, Florida. And the thing I've noticed of all my friends that do them, and I've spoken at a few of their mastermind groups and stuff, and the Airbnbs where people can drive within 4 hours of a major city, and they can have a truly different experience that's unique. For example, if they live in Atlanta and they can go to a beach town and have a really different experience and feel like they're on vacation without putting the whole family on a plane, and that those have done really well. But the short-term rentals where they're needing to fly to them have suffered more. Obviously, high-rise condos have suffered more. So it's like many things, it's spotty,
Yeah, right.
Yeah.
Makes a lot of sense. Kenny, question directed toward you. Just basically, what are your tips to go into commercial real estate? They kind of are hinting that, what's the right time to get into commercial real estate, but I think you would say it depends on the deal, not necessarily the time frame. But what are some tips there for a beginner?
Yeah. Well, it's a great question. And so first of all, I just want to point out, like Jason likes to say about the housing market, the commercial real estate can be industrial, it can be retail, it can be warehouse, it can be office, it can be multifamily. Right? Yeah. So there's a lot in that category. And then of course, inside of there, you have class A, class B, class C, and then you have location, and then you have markets, and you have submarkets. So there's a lot to consider.
And different price segments.
Yes, and different price segments. So what I always tell people, it's no different than on the residential side, is you want to go to where the market's going. So one of the reasons that we're investing in right now, we're looking at Houston, Texas pretty hard, is because a lot of people are moving there because of affordability and the weather, and there's lots of jobs. And specifically, we're around the Texas Medical Center, and of course, that stayed open during the pandemic, and that whole area is continuing to grow and be vibrant. And so, you want to be in areas that are going to be, have really good population and employment growth, and so it really doesn't matter then at that point. That could be a self-storage unit, that could be a retail center, that could be a multifamily. If a lot of people are going to an area, what it does is it puts a lot of pressure on certain kinds of real estate. So you got to, so that would be my tip. Make sure that you're out ahead and you're not trying to be a pioneer in an area.
Yeah. All right. So we've got a question from Matt. Probably directed more towards Jason, maybe not. With rents lagging, how do you analyze single family homes to rent? How do you add to portfolio with current high real estate values, comparing multifamily income-based valuation versus 1 to 4 unit comps?
Yeah. Good.
You guys understand that question?
Yeah, I think so. It's good question. And what is that bottle Kenny's got now over there?
Kenny goes from Coors Light to
you went from Coors Light to. Did you fancy it up? Because I got fancy here.
Well, I saw what you had, and I was like, I better up my game here.
I love it, George. Where's your stiff drink?
I don't know. I'm just in the hotel, and I just got in before the live stream, so I don't have any time. I've just got this water.
Oh, darn. Okay. Well, George is being healthy. Yeah.
It looks like a stiff drink, but it's not.
Yeah. Well, it's good for you. But, to answer the question, I just think that, first of all, you want to be investing in a linear or maybe a hybrid market. So when you say overvalued market, I mean, you're probably mostly looking at those cyclical markets that are really frothy and in bubble territory for sure. So be careful of those. In our markets, I mean, the prices have definitely gone up, but the interest rates are so low that the deals still make pretty good sense. Not as good as they did last year, but still pretty good. And you've just got to be willing to take a little bit less on the cash flow side right now, and be a little bit more of an appreciation investor. And I think that's warranted for maybe another 2 years. This can't last forever, obviously. When rates go up, it's going to definitely shrink this craziness in the market. But I think everybody's going to be pretty good bet for 2 years or so. And Ken, I think, is not as bullish as I am. Ken, what's your latest though? I mean, are you
Yeah, I know.
chime in on that? Are
Well,
you think the crash is coming in July?
No, gosh, no. But I it depends if the administration comes out with a lot more cash for people. That's kind of what's delayed all of this. And the fact that a landlord can't remove a tenant that's not paying, and of course we have the same issue on the mortgage forbearance piece. So and then we have the money, the unemployment, and all that kind of stuff. So all of that got kind of kicked down the road, as you guys know, and I think actually it was a good thing. I mean, who wants a lot of people to be displaced out of their homes? When the government says, okay, time to shut down. And so, but now I do believe with the vaccinations where they are and all the places starting to reopen, I really do believe that we're going to see the end at the end of this month. And I think some of the forbearance might trickle over. I've read some of the banks are working with people through the year. But I do think, the rising prices in houses have been very good for people, because if they're delinquent, let's say they haven't been paying their mortgage and they've gotten this appreciation, the issue that they're going to have is, do they qualify for a new loan or a modification or a refinance or whatever you want to call it? And if they don't, they're going to have to pay that, and they're going to have to do it through listing their house. And I think that's going to lag, in different markets over a period of time. And I think it's going to be largely dependent on, if you can go right back to the data, it's kind of like, is there a housing crash, or, how's housing doing? You have to kind of go right down to the submarket, like, a specific county, a specific city, and take a look at the data and look at the defaults. And those are largely around, the what was going on in that particular market, like where you guys are. When you shut down the tourism and you shut down the cruise ships, you shut down, some of those things, it affects the folks and their ability to pay. So, and so I think you're going to see little areas and little pockets that'll be, we'll have a lot of supply, and I think other areas will not be.
Yeah. Here's a question that's written to me, but I'd like to get your guys' take on it here. I think I pretty much know the answer, but I think people learn a lot by hearing you guys think through this question. It says, "Hi, George. I purchased a condo about 5 months ago. It still is getting built, so I guess maybe pre-construction, but has already increased in value by $70,000. Should I sell immediately?"
Well, why did you buy it in the first place would be my question. Was it to move in? If it's a high-rise condo, I am definitely not a fan of high-rise condos. I do like them to live in. I'd rent one. I rented a beautiful one in Phoenix when I lived there. And, I love them. The great views and the sexiness, they're awesome. But they just, they have very high association fees. Very controlled, very risky. If the HOA gets into a lawsuit, the financing can just evaporate. So there's a lot of third-party risk in condos in general, but especially high-rise condos. So I like single-family homes the best. Ken?
Yeah. So if it were you personally, not that you're giving advice to this guy, but if you were in the same situation, you'd probably take the 70 grand profit and move on to a single family home where you've got a little bit more control of the asset.
From just strictly a financial point of view, I'd probably say yes to that. I mean, I obviously don't know the circumstances. It's a 70 grand profit on a $100,000 property or 70 grand profit on $1 million property, right? Like, it makes a difference there, right? So, you just, with these questions, you just never have enough detail to really know. But, by and large, I'm not a condo fan, especially high-rise condos.
Yeah. Kenny, what do you think?
If the deal's good enough, anything can work, but, it's not going to be my first choice.
I'm with Jason. The first thing I thought of was it probably cost the builder. The reason it's not done is because they can't get materials. And the second one is that it probably cost, that condo was probably $20,000 or $30,000 more for the builder than when they originally sold it to them. So hopefully they hedged the price, because a lot of builders right now aren't doing that. They're saying, we'll give you a price at the end. They're saying you can give us a deposit and then you can decide. But if they have hedged the price and it really truly has gone up that much, and to Jason's point, if it's a significant part of the of the price, then probably makes sense. The problem is going to be, what are you buying then, right?
Yeah, right.
Relative to other choices in that same market. Yeah.
Mm-hmm.
And don't forget, you got a capital gains, you have a capital gains tax, you have probably some real estate commissions in there,
right?
And some other things. So it's not a 70 net. It's going to be probably, significantly less.
Yeah, that's true, because with one of the things that Ken alluded to there is interesting. When there is a high cost of buying and selling, as there is in real estate, most people would think that's a disadvantage. And I can see that side of it for sure. Trading a stock could be free or $20, right? But with the real estate, that's what makes it move more slowly. It makes it more illiquid, and that illiquidity reduces volatility. Liquidity creates more volatility. Look at stocks, Bitcoin, very liquid, extremely liquid. People can trade fast with a click of a mouse, and those prices reflect that. With real estate, illiquid, expensive trading costs.
Yeah, and it creates inefficiencies that for the experienced real estate investor, they can take advantage of.
Right. Yeah, It's not a perfect market, and that's the old random walk down Wall Street concept, right? Is that the market is more intelligent than any single player in the market. And with real estate, that isn't true. And that's what's good about it, is like
because
George mentions, there's inefficiencies.
At the end of the day, I mean, it is the market, but it's just you, the buyer, and the seller. And if they like you, they could give you a deal for $100,000 less than what they give someone else. You just never know. Where if you're buying gold, it's going to be very difficult to buy gold for 50% less than where it's trading at spot during that given day. Okay, so here's a question for Ken, but I'd like to kind of make it more general and get your guys' view on this. It says, hi, Ken, looking into buying a studio in Arlington, Virginia, where Amazon headquarters, looks like number 2 or something, will be coming. Should I wait for eviction moratorium to end before invest? So I think maybe the broader question, or I'd like to get your guys' thoughts on, is how much does that go into your decision-making process when you're buying either commercial or residential? And what I'm talking about is like this big, huge macro trend where there's a giant employer that's going into the market and they're setting up shop there. So would that motivate you to buy properties around that big employer, or do you think that's already priced into the market, or how do you guys usually look at that?
Ken, you want to go first on that one?
Sure. So yes, it's priced in. And what happens is when Amazon announces that they're going to go somewhere, and I did this in Austin, Texas, with Amazon as an example, it's well known way before they're, and sometimes they're even building something. Typically they're, building a building and putting their name on it. And also what I found is some of these distribution centers don't have the amount of employees like you think. They're massive in size.
They're robotic.
So they're not quite what you would think, as you drive by, you're like, oh my gosh, that must have a lot of employees in there. It's not necessarily the case because of the technology that Amazon's using. But in this particular case in Austin, I think it's a call center where, there's a lot more folks. And so, yes, what happens immediately when it could be a football stadium. It could be like State Farm just did regional headquarters in Phoenix and in Richardson, Texas. Texas as an example, and they announced years ahead, and they built these campuses. Well, all the real estate in the area and all the brokers and everybody was saying, hey, this is where State Farm's going to be. There's going to be 15,000 jobs or whatever it is. And I personally bought some property across the street from USAA in San Antonio for this exact reason. So yes, it's definitely a thing. You definitely want that kind of stable employer there, because it'll continually have, just like anything, it's going to continually have a flow of a demand of somebody who might rent.
Yeah.
So
okay.
My thought on that is that you got to be careful. Big employers can change their mind. We saw that happen with one of the Amazon facilities, and until they're established, and unless they're a manufacturing company that is really rooted there, where it's very expensive to move, an office space, they can get up and move really easily. So, they've got political risk too, right? So that when they don't like the political environment, those companies get up and leave. We see this happening in New York and California for sure, right? And but if they're an auto manufacturer or FedEx in Memphis, right, they're not easily moving. That's just very difficult to move all that heavy equipment. But moving a bunch of people in cubicles at desks, pretty easy, right?
Yeah. Here's another question. We got Ken. Do you foresee future for existing commercial/retail being repurposed into affordable housing?
Yes, it's already happening. And we're already seeing that. So we're seeing people, actually, there's funds. People are raising money right now for funds to actually convert office buildings to multifamily, convert hotels to multifamily. We're starting to see retail. Typically, what we're seeing right now is people are looking at, I've had numerous conversations on this issue, where what we would go in and do is actually we would scrape the whole project. So, if it's, let's say, an unanchored retail center, which means that, let's say, there's not a Safeway in there, or there's not a big draw where people are coming and going, and you're like, you got a water store, maybe a martial arts studio, and a beauty shop or something. Those little businesses, they thrive on the bigger business. And so a non-anchored grocery store, when they leave a center, that can kill a lot of those smaller businesses. And so you can buy those centers, and typically you can repurpose them into some other things. I've seen all kinds of things, and it's happening right now with malls. And there's a big malls happening all over the United States right now, where malls are dying, and people aren't going into them, and the rents are high, and they're shopping online, et cetera, et cetera. So a little bit different reason, but typically those malls are extremely well located. So we're starting to see redevelopment opportunities all over the United States for all those kinds of reasons.
Okay. Let's see here.
So a lot of those, while you're looking, George, just let me know when you're ready. But it's interesting because the shopping malls, if they don't scrape them, the easiest redevelopment there is to office space, right, Ken? And for the hotels, they can be really low-end apartments because they're obviously small, right? But office to residential is a pretty tough conversion, I think, right? Because
for sure,
they got to do all those bathrooms and kitchens. That plumbing is just super expensive.
Yeah, right. That's a good point.
Yeah, so it's a lot of times, like you say, it's just it's just the land. It's a land play. They just scrape them, right?
I don't know if you've seen this, George, but in New York, just Google this. There's 9 hotels, not far out of Manhattan, that the city took over and turned into homeless shelters. And that's also happened in other parts of the country. And so you're starting to see that now pop up, where some of these hotels that maybe have been vacant during COVID or during a pandemic, or maybe partially occupied, but anyway, they're hurting. Some of these, some of those are already starting to repurpose into something different.
Yeah, that's a sign of the times, isn't it? It's unfortunate.
It is.
It's a great learning lesson on how to repurpose, but and when we've got such a massive homeless problem,
the bigger question is, why do we have such a massive homelessness problem? It's just bad policy all the way through that's created that problem, right?
Yeah,
Yep.
It's the government and the Fed distorting the market, and unfortunately, they've painted themselves into a corner. They being the central planners, where the only thing that they can do is exacerbate the problem, because the only way to continue to inflate the bubbles, which the economy has been built on, is to continue QE, continue deficit spending, which distorts the economy even more, which creates more of the wealth gap, which creates more homelessness, and it creates more despair and a lot of these unintended consequences that unfortunately we're going to see a lot more of, most likely. I hope we don't, but most likely over the next few years. And I just go back to when I was growing up in like the 80s, or even in the 90s, to think that they would take California and Oregon, and I guess New York, I didn't even know about that. To think that they would take all these hotels and repurpose them, or have a need to repurpose them to homeless shelters, is just I just
and
never
some of
thought
these,
I'd see that.
Some of these are high-end hotels too. But George, even though their policies, the policies of the central planners are fail every time in every place they're tried, right? Just remember, the central planners always get richer.
Yeah,
That's who they're really planning for.
I know that I was reading, like in LA, they had this would have been back in the late 90s, George. They said, okay, we had a homeless problem, and they did over a $1 billion bond offering, right, to do 10,000 apartments. And it just you just read the article, it's just beyond belief how messed up that whole thing was. And the average cost when it was all done, the average cost of each home was $700,000 in construction costs as a result of fees and lawyers and all the bureaucracy
and corruption, just outright corruption.
Yeah.
Cronyism.
And that's very well documented, and that that happened from the last cycle. And so hopefully that doesn't happen again. There's a real need. There's some people really in pain. It's horrible to watch, and it's going to be interesting to see what happens over the next couple of years.
Yeah. And also too, it's just a perfect example of the government trying to, they're just looking at the surface problem and trying to fix that, which will create, in my opinion, more unintended consequences. And what I mean is, they're looking at a homeless problem thinking, okay, well, all we have to do is provide more homes, and that solves the problem, as if the person is homeless because they just can't find a house. Right.
Yeah.
The majority of the people, and I know this doesn't apply to all, but the majority of people that are homeless are not homeless because they can't find a house. That they're homeless because they either have mental issues, or they have drug issues, or something to that effect. And just giving them a house isn't going to necessarily solve the underlying issue. And you may kick the can down the road, but what you're going to find is a housing complex that you're spending $700,000 per unit that is destroyed and unusable in a matter of 6 months.
Right.
And and that's unfortunately the reality of the situation. And we'll see how this plays out. But I guess as investors, we need to detach ourselves from the emotional component of the reality, and understand that this is definitely a trend that we're seeing in certain states that's most likely to continue. And therefore, if money and capital should go where it's treated best. If we do have money in play in some of these areas, it would be wise to go ahead and hit the bid and move it somewhere where you see a lot less of that, or most likely you're going to see a lot less of that moving forward.
You know, George, it's interesting because when we talk about government and how much or how little government should be involved in the economy, and I I know we all believe they should be minimally involved, right? Everybody on both sides of the aisle will pretty much agree that government is not the most efficient. There is a lot of corruption in government. There's a lot of cronyism in government, and if you have the government large, that corruption, cronyism, and inefficiency will expand. If the government is smaller, it'll still be there. It'll just be smaller, right? So wouldn't it just make sense to have the government be smaller so we'd contain the corruption, the cronyism, and the inefficiency?
Yeah, but I'd argue that you actually, as a percentage, you would have a lower percentage with smaller government.
A lower percentage of that, I agree, because there'd be more accountability. People would be paying more attention. It'd be less to pay attention to. I totally agree.
Well, I think it's because of the people that it attracts.
Yeah, right.
Because when government has a lot of power, it attracts people who are sociopaths.
Right. Who are power hungry.
They attract people who have an insatiable lust to have power over other people. And that's mostly the people that you don't want in charge. But when government is very small and very limited and really doesn't have any power at all, it attracts people who are most likely going to be better citizens and have their head on straight and because they don't want power over other people. They're not sociopaths, and therefore the amount of corruption as a percentage is going to be lower because the people, although they're not incentivized properly because they're still in government, at least they're going to have, at least they're not going to be sociopaths that have an insatiable lust for authoritarian types of power grabs.
Yeah, no question about it. And political office, if you look back to the founding of the country, right? Political office was never meant to be a full-time job. It was something you did for a short period and then you went back home. It wasn't supposed to be a 40-year career ever. That was never intended.
Going back to your point, Jason, where anyone, whether you're on the left or the right, would agree that government does not usually allocate capital efficiently. We go back to prior to the Fed, talking 1910, 1911, and at that time, government spending was about 3 to 5% of GDP.
Wow.
So said another way, the private sector was responsible for about 97% of GDP.
As it should be.
So think about the efficiencies there when the private sector is in control of 97% of the economy compared to today, where government spending is 60%, 60% of GDP.
Yeah.
So now the private sector, which is far more efficient, anyone can agree there. The private sector is only responsible for 40% of the GDP. So
it's absolutely way out of hand. By the way, one comment that just came in here, George, JBL says, "Yep, George Washington was chosen as a general because he was wealthy," and I don't know if the meaning of that is that he didn't need the money and he wasn't trying to get in government to be powerful, or I'm not sure. Maybe the meaning is the reverse of that. I'm not quite sure. Maybe it was cronyism. I don't know.
Sure. All right. Well, let's see. We've still got well over 1,100 people that are on. See if I can find another question. If not, we'll go ahead and do some closing.
Hey, by the way, George, let's by the way, we're all going to see each other next week at your event in Miami. Let's talk about that real quick. I know
a lot of comments here. A lot of people on the live stream are going to be at the event.
Yeah,
that's going to be exciting. And then you sold it out, so you got another one in Texas, right, in 2022?
Yeah. I'm just trying to negotiate with the hotel right now. I think we're really close to a deal. It'll be January 7th through the 9th in Houston, Texas, and we'll have some of the same speakers, but then a lot of the people will be different, and we've got some guys that have already agreed and gals, so it's going to be just as amazing as this event next weekend.
George, this event sold out so quickly that George had to get a bigger location for the Houston event, so he got the Astrodome.
Much bigger. Well, I don't know. That's half.
George's big time.
Have to get a much bigger venue, that's for sure.
Yeah.
But
hey, but
maybe we'll wait till
Miami
2023 to get the Astrodome.
Yeah, well, we're gonna have like 700 people at your event in Miami. So George, I'm super excited about it.
Yeah,
good job.
It's really going to be amazing. I'm going back and forth with the speakers. I mean, you guys are going to be speaking there, and one of the cool things that we're going to be doing that I really haven't talked about is we're going to be doing 3 panel discussions. So as an example, I've got you guys speaking Saturday afternoon after lunch, and after you guys speak, then we're going to take an hour, and the 3 of us are going to do a panel discussion revolving around real estate. And then we're going to take questions directly from the audience. And you know what's interesting about that is when we were in West Palm, what was that, maybe a month ago or something?
Yeah,
about a month.
Yeah. So Jason and I had lunch with Jeff Snyder. And
great guy, really interesting.
Yeah, one of the things that had a big impact on me after that lunch was I've interviewed Jeff for the show via Zoom or whatever, probably at least 3 or 4 times. And I've listened to him on Macro Voices, 100 times. I've listened to him on Real Vision. I've listened to his own podcast, Making Sense. I listened to almost every episode. But I learned more from Jeff in that hour and a half just because we were face to face.
Right. Yeah.
And it's not just this thing where you ask one question and then, he goes off and gives you an explanation for 5 minutes or something. It's more of a back and forth type of dialogue. And, the 3 of us were kind of going around in a circle, and really we were able to flush out so many ideas in a short period of time. And it's just the point is, as human beings, I think we're able to learn so much more and absorb so much more when we're face to face with other human beings. And I think that's going to be one of the huge opportunities for those individuals who are going to Rebel Capitalist Live, to not only learn, but learn face to face. And I think that it's going to just 10x, to use a Grant Cardone term. You're learning by going there live instead of watching a ton of podcasts, which you should do as well. I'm not saying don't watch them, but I think everyone's going to go away or walk away from this event having so much more knowledge and so much more. I think it's going to have a profound effect on everyone.
Absolutely, George. I think it's going to be great, and you've done an awesome job already, and your audience is going to love it.
Yeah. All right, guys. Any closing thoughts?
Well, Ken, you want to go first?
Sure. Well, I think that there's a lot of people right now trying to figure out whether to get into the real estate market. And I would just suggest that, it's probably not good to be heavy in cash and, because of the pending potential inflation, but it doesn't always have to be in real estate. But if you do find real estate like we've been able to do, just make sure that it cash flows. Because I think the best formula is to use a little bit of cash and then use other people's money, or OPM, which is bank debt, at less than inflation. I think that, and make sure that it cash flows, and then have plenty of reserves, which is what got us through this pandemic personally. Make sure you have plenty of reserves, because we don't know, when the next thing's going to happen. But I do believe that we're heading into a renter's market in either case, because we've got low supply. We've got obviously issues around construction, and the costs around construction and affordability. But then we also have this forbearance thing ending soon. So typically, like in 2008, what that did was it put a massive push on the existing rental supply, and actually grew rents even further. So
Ken, just to clarify, when you say renters market, did you mean to say landlord's market or rental market, or what?
Yeah, I did. Yes. I meant to say that, it looks to me like, even though we have affordability issues, we're going to have rents increasing over a period of time as a result of the fallout, just like we had in 2008.
Right. Yeah, I agree.
Thank you, Jason. Yeah, appreciate that.
Yeah, and just to echo what Ken said, a lot of people ask me, Jason, if times are going to be tougher in the future and inflation is going to be rampant, and who knows what will happen with employment ultimately? Will that get better or worse? And there's a lot of discussions we could have about all that stuff that we all talk about on our podcast and YouTube channels. But what people don't realize sometimes, they sort of think of, they say these sort of glib questions. They ask these kind of like glib questions like, well, then how are people going to be able to afford to rent my houses from me? Well, here's the reality. The pressure will go on the lifestyle. The standard of living will decline for most people, sadly. That's just the reality of it. And it has declined for many people over the years. In some ways, it's gotten better because, we've got technology, and, we've got these phones, and all this stuff is great. But, no one's living like the average person doesn't have a quarter acre of land and a big yard, and, everybody's crammed together nowadays, right? So it's like George always talks about, there's a lot of cross currents, right? But that's what will happen as these rents do climb. There's a lot of rent pressure building up that hasn't released into the market yet, and I think we're going to see rents go up quite significantly. We're seeing it somewhat, but I think there's a lot more of it left. And I think that the housing prices, one of the things I got to talk with Ken about yesterday on his YouTube channel is this new index I'm releasing called the Hartman Comparison Index. And I'm going to talk about it at George's event. And when you compare the price of housing to a whole bunch of other things, it's actually still pretty cheap. If you're just comparing it to one thing that most people are doing, which is the dollar, it looks expensive. And I would ask you, have the house prices gone up, or has the value of the dollar declined? That's really the question. And I think everybody watching knows the answer to that without me even saying it, because George, your audience knows, and Ken, yours does too. And just to give an example that I shared with Ken yesterday, to buy the median price house 21 years ago, literally a generation ago, the median price house, if you wanted to buy it not in dollars, but in gold, it would cost 610 ounces of gold. And today, that median price house only costs 208 ounces of gold. So priced in gold, a house is 2/3 cheaper than it was a generation ago. Like, really think about that. That's pretty significant. It is more expensive than it was in 2010, though. In 2010, so just to go over those numbers again, 21 years ago in 2000, 610 ounces to buy a house of gold. In 2010, 162 ounces of gold to buy a house. Now, 208 ounces of gold to buy a house. So cheaper than it was 21 years ago, a little more expensive than it was 11 years ago.
Yeah, that's really an interesting way to look at it. It is. Maybe that's when you're thinking of prices in real terms, and you're having to deal with the CPI, which is a number that is inaccurate.
Totally bogus. You're too kind, George. Inaccurate. It's bogus.
Yeah.
It's a scam.
Yeah. Maybe looking at it through the lens of gold is, that'd be interesting to do that with all assets.
George, I will. At your event, I'm going to compare housing to the price of oil, gold, orange juice.
Oh, no. I'm talking about
a bunch of things. Yeah.
Gold.
Other assets in general. Yeah.
Like gold, like the stock market valued in gold.
Right.
Or commodities valued in gold or oil, something like that. Yeah, very interesting.
Yeah. Can I give you one more on that? And Ken and I talked about this yesterday, because you mentioned the stock market. So the most widely used measure for the stock market is the S&P 500, right? And in 2000, to buy the median price house, it would cost you 1,884 shares of the S&P to buy a median price house. In the year 2000, so 21 years ago. In 2010, it would cost you more, 2,179 shares of the S&P to buy a house. But today, it only costs you 898 shares of the S&P to buy the median price house. So priced in gold and the S&P, houses are cheaper. And the one thing, I love the way you say it, George, because and I'm going to talk about this at your event. You always say, is it cheap or is it expensive? Right. And I love that because that just clears away the clutter and the confusion, right? Is it cheap or expensive? And then you ask, in what terms? Gold, oil, dollars, euros, right? What commodity do you want to use?
You know what my pushback would be? Is if you want to measure the price of housing in gold, you'd also have to measure the income in gold.
Yep.
Because incomes, obviously, along with the interest rate, are what people use to buy the house. That's a big component, obviously, the main component other than interest rates. So if in fact housing is a lot cheaper in terms of gold, the average wage would be far less in terms of gold, when adjusted for the real rate of inflation as well. So it's weird because it would make housing more affordable if you had a high wage, but for the average person, it would mean their wage has gone up a lot less, and their wage is still consistent with the overvaluation of the home in nominal dollar terms.
Yeah, right. Good point. So I'll just tell you on that, and we'll close with this. You guys can take it from here. But 21 years ago, to make your mortgage payment on the median price house on the average income, it took 69 hours of work.
There you go.
See that mortgage.
Yeah.
Today though, it only takes 47 hours.
Yeah, so they're
cheaper.
More of an apples to apples. Yeah, that's interesting. Yeah. Okay, cool. Well, let's go ahead and do some shout outs. We've got 1,123 people on here.
Ken, this is going to take an hour.
No. I don't shout out here. No.
Okay, let me pour another drink.
No. Look, why don't you guys? Can you guys see the chat thing, or is that just me?
Yeah, I can see. Ken can see.
No, well, then you guys. Oh, you can't, Kenny.
No,
Jason,
I can't. But
help me out. Do some shout outs. I'm always the guy doing the shout outs. Let's see your best impression of George Gammon.
How do you do it? Do you just go from the top? There's so many. There's Ripley 2020, Mono Toro Trading, M9, Kevin Schmidt, Jason Kincaid, RR, Marie Casilius, RR, Fudfit, Jay. Now we're getting repeats, so I gotta just go through them.
It's a hell of a lot harder than it looks, isn't it?
It is. Yeah. Adam Macias, Tech Reviews, Kyle in PA, Jasmine, Biff Henderson. I love it. We got Dennis. We got Born Like Stars. Wayne Smith, Don H, Jasmine was mentioned. Okay, a lot of them are repeating because they're talking to each other, in the thread.
Memory, like you play when you're a kid, when you flip over the card and you got to put it back and you get the other one. All right, well, good job. We'll give Hartman a round of applause there.
We got Mike. Oh, don't forget Gene Morris though. Gene Morris, that's your bud right there.
What about the unicorn? What happened to the unicorn?
Oh yeah. The unicorn already got the shout out, Ken.
Yeah, the unicorn.
I know, but I just had to. You got to wrap up with the unicorn.
Oh, for sure. Yeah.
All right, guys. Well, thank you very much for your time. Thank you for joining us, and check Jason out on his YouTube channel. What's the name of your channel, Jason? Is it Jason Hartman?
Jason Hartman Real Estate.
Okay, Kenny. Is it just Ken McElroy?
Ken McElroy. Yep.
Okay, awesome, guys. Thanks for joining us. Have a fantastic evening. We'll see you on the next video.
Good night, everybody. Thanks, guys.